We would always encourage our clients to, think long term, right? We're talking not just buying investment property for 5 or 10 years. We're trying to get an asset that you can really never sell. If you're going to use your borrowing capacity, use it wisely, buy assets you can hold, don't have to pay capital gains tax, you can reborrow on it, etc. And make sure you factored in all your lifestyle home decisions before you start buying these investment properties. And 3 years later, you say, I'm going to have to sell that to buy a house, etc. And if you're going to bet long term, we'll bet on the quality assets, right? And then bet on the better quality assets within that suburb, and make as least compromises as possible, right? Etc. But some people haven't got the budget for that, right? Because to get into these, you need big budgets, especially to get into the better parts of these suburbs. And I'd much rather a better quality in a poorer suburb than a poor quality in a great suburb. Just ride the markets much better and protect yourself. But I mean, when you start looking at these suburbs that are more suburbs or areas, let's say, that are great investments long term,
yes,
but maybe they've got a short term issue at the moment. They're starting to really see a lot of people run for the hills because of or try to cash in. And maybe you can bet on a 30-year time frame and say, well, we really think these suburbs have got scarce. They've got supply issues, they've got landlocked, but they're great lifestyle and they're close to the capital cities, etc. And I think that's a really interesting thing because you're getting better buying conditions probably because more listings, but you're also not just, going where there's opportunity that won't give you growth. It's potentially a bargain hunting market, but when you try to sell it in 3 years' time, there's no guarantees you'll even make money, right? So where are you seeing that? Great markets, we believe, but they're also getting a big increase in inventory and listings.
Yeah, so I've identified a number of metrics that are what I'm calling evergreen metrics, predominantly census information.
Okay.
What I've done is just overlaid one property market set of metrics, which was what was the growth rate per annum before the big boom, prior to 2019. So that was it. It wasn't an overfitted, overly complex thing. So I'll just list down those variables. Minimum income, right? Minimum household income of 1,500. Arbitrary. And think of this as a Venn diagram. And, yes, you could find great locations outside of that crossover point in the Venn, but this is my approach. Minimum 1,500, mortgage repayment maximum 2,500. So I didn't want, people that are going to be too stressed in the coming year. Unit count maximum 50%. So I wanted that, a good blend. Balance. I didn't want too much density. Fully owned. I've gone that's my classic proxy to say this is going to be a little bit of a stabilizing factor, a bit of a rudder, of a minimum 30% fully owned. Rental tenure, min 10, max 40%. So it's a sweet spot. Not too many renters because you get up above that 50% mark, you start to see a bit of volatility in that rental market. It's got a hospital. A big hospital, a decent sized hospital, not 50 beds, but something significant. An average CIFA score, the socioeconomic score of 5 or higher. So I've gone for the upper end of that. And that doesn't mean it's a snobby area because those other variables kind of give us some sweet spots there. So you can have lower priced areas that still have high CIFA and minimum 2.5% growth rate leading up to 2019. Over a 5-year period. So they were my variables that gave me then magically a nice rounded number of 50 SA3s that I'll be carrying for this year and through next year. And that's my focus.